Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Sean Thompson.
And me, Hartej Singh.
The CIO Chair's guest today is Richard Tomlinson, Chief Investment Officer to the Local Pensions Partnership Investments. He is also an Executive Director on the LPPI Board and Chair of the Stewardship Committee. Richard has more than 20 years of investment experience. Prior to joining LPPI in 2017, Richard was Head of Portfolio Advisory at Alborn Partners for 6 years, where he advised European investors on alternative investments, portfolio construction, and risk management. Earlier in his career, Richard was Head of Multi-Strategy at Old Mutual Asset Managers, and prior to this, an analyst at GNI Fund Management. Richard holds a degree and a master's degree in engineering from the University of Cambridge and is a chartered alternative investment analyst. Welcome to the CIO Chair, Richard. It is an absolute pleasure to have you here. And as I always say to our guests, I hope you are sitting comfortably.
I am. I'm very glad to be here, Sean and Hartej.
Fantastic, Richard. So obviously you're an important voice within our industry, but for those who don't know what LPPI do, could you just give us a rundown of what LPPI does? And importantly, who does it serve?
So LPPI is one of the local government or LGPS pools. We were created around 10 years ago when the then Chancellor George Osborne decided to create essentially asset pooling vehicles for the local government pension schemes. There's a large number of them. I think it's just under 90 currently. To place assets and consolidate them into vehicles to be managed to generate scale and essentially try and improve outcomes for the stakeholders. So I'm the Chief Investment Officer of one of those, and there were 8 of us, and they're currently going through a process of consolidation. So there will be 6 pools from April 1 this year. And we, as I say, we manage assets on behalf of local government pension scheme funds.
Can you give me examples of the kind of end recipients of the pensions?
Yeah, so it's not quite as homogeneous as the name might suggest, but broadly, it's managing assets on behalf of workers in local government. So people who work for local authorities and the like, but there are a few other types of employers within the pension scheme. So ultimately, it's the underlying members of those employers who are the ultimate beneficiaries, and the contributions are obviously coming from the employers and the members themselves to fund the pensions in the long run.
That's fantastic. And could you let me know, what is the day-to-day life of a CIO at LPPI?
Busy is one thing I'd say. And I think it's like all CIOs, it's quite a complex job. There is no single definition. And that part of the reason why I love being a CIO in the role, that one CIO role job can differ significantly from the others, as I'm sure, as the podcast has shown. So for me, it's overseeing an investment team. So our investment team is approximately 70 people now with the roles we're filling up. And it's then overseeing the essentially implementation of our partner funds, our clients, our partner funds, their portfolios in line with the mandate that they've given us. So we have always worked with the full delegation of the portfolio to implement 100% of the assets in line with the strategy that they've given us and the mandate they've given us. And then it's essentially implementing the assets in line with that and overseeing them. So like most portfolio management roles, there's an element of asset selection, strategy definition, implementation, manager selection, oversight, challenge, and how that comes together. So there are some things that are very similar to most other CIO roles, and some things that are probably a little bit unique to the local government pooling environment.
That's great. And so obviously you're a CIO today. Could you give me a sense of your journey from university to your current role?
Of course. So I think to give it a bit of context, I was in university during the previous sort of tech boom, the mid-late 90s. So everyone was being an entrepreneur. So I had this bright idea with a mate of mine that we'd be entrepreneurs. And I think we were runners-up actually in the inaugural Cambridge University Entrepreneurs Competition, which was interesting looking back how that's grown. And then off the back of that, we ended up essentially working for the NEC group in Birmingham. That then evolved through, I then decided that I needed to get a different kind of job, let's say, without going through all the details. And I ended up in 2002 working for GNI Fund Management, which was a sort of hedge fund style manager, let's say. It wasn't a multi-manager setup, essentially. That evolved into Old Mutual, who was the parent company, where I was the head of, I think, what we called multi-strategy, multi-asset until 2008. The world changed. I did my own thing for a year or two, trading my own money in independent consulting, joined Allborn Partners, which was really transformational, great experience. And then in 2017, joined LPPI for the role that I joined as head of investment strategy. That evolved to deputy CIO, and now I'm the CIO since 2020.
So, Richard, just to go back a little bit. So, you took a degree in engineering,
I did.
and then you've just mentioned that you then started doing something in the events industry. How did going from being a master's degree in engineering get you into the events industry? I'm intrigued.
So yeah, it was a bit of an odd one, but it's a good story. I hope it's not too off the topic. So we were working on essentially building the technology behind building large domes and sort of very large span structures. So my mate and I thought it was a good idea to go to the NEC in Birmingham and tell them that they should use our technology for the next arena they were going to build. And essentially, the development director said to us, "Well, you guys, you're dreaming, you're a startup, you haven't got any capital, you've got no experience, so you're not going to build a £100 million project. But I like the chutzpah that you've turned up here and you're essentially trainers in a university minibus and told me you're going to change the world. So I'd like to hire you." He offered us a job, which was essentially not that dissimilar to what I do today, which was to think about economic development and think about deploying capital and how large-scale projects can spur economic activity in an area, essentially. I did that for a year or two, and then the world changed with 9/11 and other things. And then I decided I needed to get a job that was probably more aligned, a different kind of role, let's say, and ended up in the city.
Very interesting. Thank you.
That's fantastic. So moving on from your sort of career trajectory, if we could talk about the industry. So the UK pension industry is obviously very interesting right now, and there are lots of changes happening. Could you give us a sense of what is happening in the UK pension industry today, and what are the trends that you can observe?
Yeah, there's a huge amount, I think, has been changing. And I think at the very highest level, there's been a lot of policy discussion driven by government and other parties in that sort of government policy nexus. I think you then have to break that down a little bit into different elements of pensions management, because I think something I get personally frustrated with is when people talk about, and I'm doing a little inverted comma with my fingers, UK pensions do this or that. Well, it's not a homogeneous group. There's very, very significant differences. So at its simplest level, I would break it down into DC, corporate DB, and LGPS. There's subdivisions there as well, and there's other subtleties, but very broadly. And there's quite different things happening in the UK pensions industry for each of those. The overarching theme is there's government policy wanting to have more investment domestically in the UK and be part of the broader ecosystem, and that conversation around that. And that is a national conversation. It's not just the UK. It's happening in Canada and other places. And I would always link that back to the geopolitics of where the world is going, call it splintering, call it economic nationalism, call it friendshoring. All of that stuff is related in my mind. And then economic security and supply chain stability is a huge. It's really not just government saying we want investment at home. It's much broader than that. And then within the LGPS, we're consolidating as well. So government is something called Fit for the Future, is evolving the government pooling agenda for the LGPS, which is what I touched on earlier, with the pools going from 8 to 6. And then within that, there is an element of this UK local investment encouragement, let's say.
That's great. And obviously we think of the UK and understand that context, but are there any sort of lessons that are being learned from the way pensions are managed in the US, Canada, or Australia, for example?
Yeah, I think I don't think I'm speaking out of school to say, I think if I think about where government policy has been going, I think government and others, and I'm pretty sure they've explicitly said this as well, they have looked internationally for guidance of, again, what good looks like in inverted commas, the schemes that have worked well. And certainly if you were to ask me, where would I look for guidance? I would say you'd look from a DB perspective, and by DB I'm referring to what I call quasi-sovereign DB. That might not be quite the right words, but something like the LGPS, something like a CPPIB. I'd look to Canada as a model of what works, given they started a long time ago, but they've now built sort of assets in those vehicles which are very significant relative to their GDP. And I forget what proportion it is of GDP now, but it's very material. It might be 100%, I think, actually, off the top of my head. And then for the DC side of things, I think clearly many would argue the Australian superannuation system is a leading beacon in what good looks like. So I think there's those two drivers there. And so I think there are subtle differences, but certainly the direction of travel for the LGPS, I think, has been heavily influenced by looking at what lessons learned from Canada.
That's great. And And given that you are consolidating number of mandates, so i.e. you're a manager for a number of different mandates, could you give us a sense for how clients differ? What assets they're allowed to buy, what their liability structures might look like, or any other sort of responsible investing policies?
Yeah, so that's a really interesting question. I think on the one hand, you could argue that the LGPS is very homogeneous. It's one scheme. It's run this consistent set of rules. The maturity of the liabilities varies a bit, but it's not that different. But there is some variation. However, where you get more material differences are around, let's just call it the views on RI, sustainability, ESG. That is becoming more polarized. It's too emotive a term, but there's more variation. And I think that's again in line with the broader political development we're seeing globally. So there are clearly very significant differences now in different funds and how they view it. And I find myself having this conversation probably 3 times a week where I say, pull up the spectrum of capital and almost say to people, point where you are, because it's almost now getting people to think quite carefully. Are they pure financial investor, ESG integrated, sustainable, impact, or philanthropic? And having that direct conversation and then actually bring it down into which part of the portfolio as well. So certainly there's a very significant variance now around that part of the conversation. And in terms of to degrees of risk appetite, even though the liability profiles are broadly similar, there is quite a significant there is divergence in the views on terms of where people want to run risk. As you'll be both familiar as a long-term investor, certainly with DB environment, you can run more risk on the funding side of things or more things on the investment side of things. And then it's deciding what balance you want between the two. So we published a paper a little while ago with the risk smile type idea, but it's trying to find that balance. And that does vary between different partner funds.
How do your clients choose which pool to be managed by? And I suppose also, I mean, just looking at, you've mentioned the reduction in the number of pools. How do they get moved across to the remaining pools that are available?
Yeah, so early on, the government was quite open-ended, let's say, or permissive in what they wanted to happen with pooling. So government said, this is broadly what we want to happen, but you go away and think about the how. And there was a coalescence of different groups who came together to form the 8 pool and think about how they did that. But there was very significant variance in the approaches taken. LPPI was formed from 2 large funds coming together and saying, we want our assets managed in a certain way, which they looked very much, I think, to the Canadian model and said, that's the sort of model we want. So LPPI was formed to build that. And I joined shortly afterwards and helped grow and shape that. I forget when the timing would have been early last year, government went through a process and then said there were 2 pools that were no longer to continue. Within those 2 pools, there were 21 funds, and those funds then we went through essentially a beauty parade where they found new homes and they've joined different pools. So they've joined 1 of 4 pools.
Yeah, so in essence, I mean, you are competing against each other to manage the mandates that you're offering.
Possibly, I hope not. It would
Okay.
be my view. I hope it's more collaborative. I think if I was really honest, I think there may have been a little bit of the summer last year where it may have been a little bit competitive with people trying to work out new homes for funds. But actually, I talk very openly and frankly with my opposite numbers in the other pools. We have a collaborative relationship, and certainly we work very closely with a number of other pools now to run combined mandates and stronger together type ideas, collaboration. So and I'll just to segue slightly. That's something I love about this job, is that I don't have the commercial need to be on a plane flying around Europe or the US raising assets and similar. So something I really appreciate about this role.
That's great. We've spoken about sort of over the podcast series so far, corporate pension schemes and now sort of more either public facing pension schemes. What are the key differences in managing those? And if I could ask, for example, like what is the role of consultants within the LGPS arena?
Yeah, so on the corporate DB versus the LGPS, and not everyone agrees with me. I wrote a LinkedIn post on this about a year ago, I forget, and various people popped up and said, I disagree with you. However, I would do the framing. I'm being really simple and reductive, but ultimately a lot of the DB framing and motivations is about finding the lowest de-risking from the corporate perspective. It's finding a way to meet those liabilities that doesn't negatively impact the corporate. So it becomes a risk management job because you're trying to de-risk the glide path to paying pensions, but because you have more certainty on the liability profile, because they're closed to new membership. The LGPS, on the other hand, is very, very different because it's open to new membership and they're very long dated liabilities. So you become more like a growth investor from that perspective. So then it's about, how do I take this pool of capital and optimize the return I make on that capital within the risk envelope I've got, and try and minimize or optimize, I should say, total cost of delivering the pension promise in the long run. So it's total life cycle from our perspective. So they're quite different things. Whereas in the corporate DB world, I would argue, and again, some people may throw bricks at me for saying this, at times in the past, you may have been incentivized to do things that were a bit sub-economic because it gave you that de-risked option, i.e. buying real yields when they were negative, for example. But it made sense to do it because your objective function was to de-risk, not optimize the return on capital over the next 40 years. So for the goal for the LGPS is ensure payment of pensions affordably and efficiently. So it's that affordably point that then means you need to sweat the capital you've got today to minimize the future take on in terms of contributions. And in terms of role of consultant, there's a delicate line to walk here because the future, the bill, the consultation, has evolved the role of consultants in the LGPS. My personal view is that it's certainly not black and white where this is going. Consultants have been deeply involved in the LGPS, and my suspicion is the consultants and the individuals will continue to be deeply involved in the LGPS. The who does what might change a little bit, but I don't believe that the role of consultants is disappearing anytime soon. It's just evolving into something slightly different. And different funds and different pools have different needs and relationships with different consulting groups, but I don't think they're going anywhere. I just think they're evolving what they do currently.
So with the total life cycle approach, how do you measure risk, and what is your risk target? Like, how do you think about the right appropriate amount of risk taking within that portfolio?
Great question. So the structure we use is to agree a risk appetite statement with the underlying partner fund, which then defines a few. It's high level. It's not super granular at the level we agree with the partner funds, but it's to then think about just things like putting some framing around the funding level, but where they want to be at what level, put a RAG rating around the funding level that they operate at. So it might include a statement such as, we would like to maintain a funding level over 110% over the next 20 years or something like that. And then we then use, on that one specifically, we'll then use ALM model. We use Autek Glass, and then we use that to then frame the risk modeling of the future set of assumptions. And it's not just the fund level, there's other things. There's liquidity in there. In our structure, we then have essentially mandates and envelopes to manage the risk profile of each asset bucket. And we agree a strategic asset allocation with each partner fund, or they tell us, I should say. We give them advice on it. They then hand us back what strategic asset allocation they want us to implement. We implement that, but it's linked into an overarching framework where we define their risk appetite and target returns at the mandate level, essentially.
And for example, like diversification, I guess in your sort of future state modeling, are you using different scenarios? How do you think about diversification? And is it like a qualitative or quantitative output?
It's a bit of both, but put it this way, I am very cautious about leaning on the quantitative stuff where if you're relying on some kind of Markowitz optimization or historical correlation matrices and similar, that type of thing. So if I think about what we do, we certainly do narrative-based scenario thinking, and the objective is to try and build portfolios that survive and prosper in the long run, and then the diversification is part of that. I'm also quite cautious. I talk a lot to the team, or we talk a lot about not just thinking because you've got different asset buckets that you have, I'd call that optical diversification, that quite often you have thematics that tear through the whole portfolio that are everywhere. And I've been talking a lot more recently, and we've seen this through multiple cycles. When you have a big thematic in play, you have the same positioning and trade everywhere. Saw this in many places historically, such as the oil in 2005, 2006. Everyone, everywhere there were long stuff that benefited from oil going up and short stuff that was going to get hurt by oil going up. So you had the thematic trade everywhere, and you've got the same, to be honest, in AI at the moment, where it's everywhere. So that, to me, is not just diversification by asset class, it's thinking thematically and then thinking forward looking and then doing some kind of scenario analysis. And we've done red team, blue team type stuff. The teams trying to stress test the portfolio and the approach and the model. We do lots in that. And there's way beyond just correlation type stuff.
So it might be a naive question, Richard, but with all the local government plans that you manage, why would they have different investment strategy policies? And why would they look at diversification or risk differently to each other?
I think there's an element, like with everything in life, there's an element of where you've started from and the legacy and the history. But in reality, I think many funds would say, and I fully agree, that the liabilities sit locally with the local authorities or the employers. The funds have a unique structure, which I'm not expert in. There are others who are deeply, deeply expert in the real mechanics of how the structure works or statute that sits around it. But the liabilities sit locally. If there's a shortfall it comes basically out of local taxation. So it's local tax, not national
Yeah.
tax. And then the councillors and others and the pension fund committee is elected to meet those liabilities locally. Their lever is local taxation. So they will talk. So there is this idea of local accountability, which makes sense. And then the funds themselves will set, so essentially they own the risk. So they set the risk envelope and appetite for the fund. And then the pools will implement that. So that's the way it will come together. And then it gives that ability for the fund themselves to own the investment strategy and keep that essentially sovereign to them.
And when they're looking at the asset classes that they might be investing in, and more importantly, what you see is the opportunities available out there in the marketplace, how does the conversation work between you and them in terms of convincing them, talking to them about those opportunities and seeing whether or not they would add them to their portfolios?
Yeah, well, that's, as I said, it's an evolving conversation because previously there was this, for the broad local government pension scheme, the pension fund committees were selecting fund managers and being quite direct in that and owning the asset allocation. Where we're moving to post-April is that all the funds and all the pools themselves will own the asset selection piece, and the partner funds will define the SAA and the mandate. So that is a change. We've always operated that way for nearly a decade, but that's subtly different for everybody else. So the key conversations, I think, if I look forward, funny enough, I was on a panel yesterday having this exact conversation. To me, it's an engaged conversation. It's what it's definitely not is a blunt, put a number in a box that you're going to have 45% equities and that's that. There's an engaged conversation. Certainly the way we've always operated is very much on each partner fund's portfolio is unique to them. And we think like a discretionary portfolio manager for them, like you would have at a wealth manager or similar. We look at their portfolio in isolation and then think about how we meet the goals within the mandate and the constraints, not here's some building blocks and just shove them together, basically. So it's very, and then in that you've got to have a deep conversation and set up an empathy is the word I'd use, an understanding of what they're really trying to achieve and understanding how and that comes back to the balance between how much risk they want to run in investment versus funding strategy. It comes down to the SAA, liquidity risk, how you manage the treasury. It cuts across so many angles. What it's definitely not is blunt, black and white, or anything like that. It's empathetic, engaged, and running a portfolio, and ultimately you serve them. So they own us, and they're the boss.
Perfect. Thank you.
Of the sort of the many debates that are out there, for anyone who follows your writing, you're able to sort of, take the noise and try and sort of distill like actionable insights. So when I'm thinking about some of the key questions out there, it would be active versus passive, in-house versus outside, and the role of private assets. So those are sort of three things that keep coming up, and it is almost like beliefs on each side as opposed to sort of analysis. How do you, for example, like navigate these debates? So if we start with, let's say, the active versus passive debate, recently there's been some sort of policy suggestions from some of the parties. Like, how do you navigate that?
Yeah, it's a great question. So on the active versus passive, to me, and this is I think most investment managers and CIOs would say, you look at the mandate of what you're trying to achieve and you think about that. You think about the mandate and the risk appetite and you start thinking. So on the active versus passive one, I tend to come back to, are you a top-down or a bottom-up investor? I think if I get this the right way around, I might get my statistics the wrong way around. Do you happen to have a type 1 or a type 2 error? But basically, error of commission or error of omission is what I'm getting at. Buffett versus something I think, what I'm getting at is, if you think about how do you think about investing in equities? Let's use equities as the example. Is your equity portfolio trying to do the best job it can at capturing every possible opportunity within a risk universe, say globally, and therefore you don't want to miss anything? That's one way of framing the world, and that's quite difficult to do. That's one thing. Or is it saying we have a set of investment beliefs, and that might include RI, ESG, or other things, and we have a set of liabilities to meet, and we're going to build the best portfolio we can in aggregate to deliver that outcome. Now, that might lead you to a slightly different conclusion, because that's then, I don't mind if I miss opportunities over there. I'm trying to build a portfolio that best meets my mandate and liabilities. And those are philosophical points. You can argue it both ways. So that on the first one, that might lean you more towards passive, because you're then saying you're into the managing uncertainty and what you do when you don't know and all that kind of stuff. If you're thinking about this more bottom up and meeting liabilities, then actually you might say, I don't care what MSCI World does. I'm trying to build an integrated portfolio, more leaning towards a TPA type approach that some people have been talking about. And that's a philosophical point. So I would come at it from what are we trying to achieve here? So there's parts of me that thinks just do passive, and there's parts of me that will argue, well, you know what? No, bottom up stock selection, align with the beliefs, meet the liabilities. Very, very driven by the mandate. That's how I would come at that. Not to say, I do not believe in black and white unitary view saying it's this or that. So I think that leads you to some unusual places, let's say.
But a brilliantly reasoned answer. I appreciate it. And so I guess on to the next question, and I guess this depends whether you sort of lean towards the active or passive sort of approach for a particular client. How do you decide whether to invest within an asset class from an in-house perspective or whether you outsource that to an investment manager?
So a few things you touched on. I've got my degrees in engineering, and they're actually manufacturing engineering. So I grew up with the make versus buy outsourcing narrative, which is actually somewhat inverted from when I was at university. Now it's all gone full circle. But that mindset of distinctive competency, I almost sound like Michael Porter. Where are your competencies? That type of mindset. I just find it very hard to get away from that. I'm also someone who's very, I think, possibly self-critical, but also very direct. So I don't, you got to be very careful about drinking your own Kool-Aid. So if you're going to do something, you've got to hold yourself to account and do it properly. So if we come at it from a make versus buy framework, you say, let's think about the stuff, first of all, that's utterly strategic. That's one of the things that are mission critical to what we're trying to deliver. Does this activity fit in that bucket? If it does, then you might think about bringing that in-house. Then you've got to think about, is it credible we can do it? Do we have the skills? Or is this something where there's something unique that we have no way of being competitive at? As an example on that one, I always use equities. So we do run some equities in-house, but we do long-term quality compounding type stuff where low turnover. Is it plausible you can take a quality approach with a team of people that we can hire into our organization and do that work? And I think that is credible, and we've been doing that for a long time. If I go right to the other extreme of equities, I'm then thinking HFT, low latency trading, the arms race. There's 5 or 10 people globally who can compete in that. You're talking the D Shores, the Jane Streets of this world. There's no chance that anyone like us can. There's about 5 or 6 people who can do that, and they spend hundreds of millions of dollars a year on tech budgets and similar. So that's the other extreme. And then if you start working backwards through the equities, at some point you get towards the what I jokingly call the earnings guessing game, but short mid horizon trading, and then you're up against the hedge funds. I have zero. It's not believable to me that we could compete with hedge funds on that kind of 3-month horizon, thinking about earnings and where do we get edge legitimately from. I just no. So if you follow my logic, that gives a case study, and then the other one is then risk profile. So on the risk profile conversation, I always use FX overlays as the example. Why? I just can't see I'd ever want to do it in house because I can pay someone who is so specialist at doing this to take the operational risk, pay them a relatively small amount of money compared to our total assets. The probability of them getting an FX hedge the wrong way around is very low compared to us. Because I say this and sometimes people cringe, but most people who are a bit older have put an FX hedge on the wrong way around. It's just one of those things. It was so easy to do back in the day. And the reason you worry about it is because the notional is massive. So if you get it wrong, you could have a very big hole in your portfolio. And then you're like, what do we do about that? So that's an example of why you wouldn't do it from a risk point of view. So you come back to it, some combination of importance, risk appetite, capability, and the cost of doing it externally might be so low. Why would you do it?
So again, a really well-reasoned answer. Appreciate it. And so I guess on the third of those questions, how do you see the role of private assets within the LGPS framework?
Yeah, it's interesting. So like I did on pension funds. So private assets. That's now what does it really mean? Because we're in a time where I think the line is blurring anyway between public and private. But if we take that private assets means that I think what people normally refer to private equity, private credit, direct real estate, infrastructure real estate. There's probably some other things on the side. I think what we're talking about is things that aren't listed and are deemed to be illiquid. So we would say that I just see it as an access route. You look through the portfolio at the underlying exposures and think about what are you trying to achieve. Obviously, liquidity characteristic is different and governance rights are different, but there are certain things that you can do in private markets that you just can't do in listed, whether that's pure play exposure to certain things that you might want to do from a return point of view, or potentially from a ESG, RI point of view. Maybe a better example, I would say, actually, is local investing, because LGPS, we have the pillar of the bill, and Fit for the Future is local investing. If you want to invest locally in the West Country, you're probably very, very unlikely to do that through public markets. So if I raise that up, we think about it holistically, but the critical point is managing liquidity, and we're fairly hardcore on how we manage liquidity within the portfolios, making sure we have buffers. And then the final point is the thing that I think is more scary for people is contingent calls on capital. So you get a large call on your private equity portfolio. So we manage that very carefully.
So just following up on you mentioned UK again. 2 questions. Do you think that the LGPS are sort of being pushed? And more importantly, obviously you are looking at it. So what sort of things are you looking at when you're looking at investing in the UK at this moment in time?
I think it's like invest in the UK, but what does that really mean? And there's lots of debate on this. So I think I've been talking about this in a multi-tiered way. So I think if you break it down into local, hyperlocal, whatever you want to call it, regional and national, and I think certain assets fit in those buckets in different ways for most people, most investors. And what I'd say is that certainly for the LGPS, there is a significant appetite for affordable housing because I think we're all familiar with why. So there is an appetite for investing in housing locally, and that is you build something in a local patch, it's there, it serves that purpose, it's very clear, it's locally based. I think if you step up to regional infrastructure assets, it's quite rare that you build some infrastructure that just serves one patch. It's going to be bigger. It's going to be regional or national because if it's a wind farm, it's a road, it's whatever. And then I think the bit where my views might differ from some others is on corporate risk. I really struggle with the idea of doing corporate investing locally at a local level. I think it's a national endeavor. And the reason I'd say that, you back a business that's based somewhere, not an economic center, let's not use proper nouns. They're successful. They start scaling. What's the probability they move to Manchester, Birmingham, London to access a workforce and similar? I think it's quite high. So even though you may have started the business off, they move. Then what do you do? Do you say, well, we're not participating in the follow-on rounds? Or so that's what I'm getting. I think it's a national conversation on the corporate risk.
So in the previous podcasts, when we've been talking about this, others have been saying they've got the capital, they've got the money ready to invest, but there's nothing out there really that looks attractive. Where's your view on all of this?
Yeah, and I certainly have sympathy with that view, and I've made that argument in the past. And I think that is correct in some areas. Again, you've got to get into the granularity of that. In UK infrastructure, there is a degree of truth in that. There are investable projects, but then it's finding how you price the risk and what bit of the capital stack you get involved in. They're very long dated. As we all know, we're investors. If something's long dated and uncertain, it's quite hard to invest in it. So yeah, there's definitely some element of that in the infrastructure space. I'd say in terms of housing, there are projects around of activity. The issue with housing is viability. And that is, unfortunately, in many parts of the country, it costs you more to build a house than you can sell it for. So yeah, you can say we're owning it for the long run and we're renting it, but then you have to do a bit of spreadsheet gymnastics sometimes to make the numbers work, or add in some very Herculean assumptions. And again, that can be fine. So it's something I'll openly talk to people about and say that if you're going to do certain parts of that, I think you have to be very credible on your return expectations and accept there's a haircut versus a full-on commercial return that you might get. And absolutely, but put that in the mandate. Don't pretend it's not there, because I think that's where in 5 years' time you could look back and go, yeah, not sure about that bit of underwriting, and that becomes difficult. Be open and honest up front on that bit. And on the corporate side, well, the British Business Bank and others are very vocal on the need there is significant opportunity for scale-up capital. There is demand for scale-up capital. We have a great ecosystem of startups and similar. We haven't got the institutions and the pipeline of capital to fund those at this point in time. So I think it varies between the different asset groupings.
And with the uncertain world that we seem to be living in at the moment, I mean, how does your thinking around investing in the UK versus global investing, and whereabouts you're positioning your portfolio? What are you thinking about when you're thinking about what's going on in the world?
So I'd say that my usual narrative I'd say on this is the world has changed. And
Mm.
for most of my career, when did I start? I think 2000, say, the objective function for most nations in the rules-based order was shared economic prosperity or something like that. You can argue that it was a sham, but broadly speaking, people traded and that worked. That's long gone. We're now in an era of spheres of influence, mercantilism, economic and military strong people rather than men, I think it might be the way you'd frame it. And who's got the biggest bat? And it is, we're back to a world of bullies, basically. And that is changing how people think. It's economic nationalism. Through COVID, supply chains got stretched. And I think governments are very aware of economic nationalism and security of supply, not lowest cost of supply. So you add all that up and then layer on top, actually, during Ukraine, there's some of the sort of choke point argument about people, depending whose assets were where, you might not get them back. I think that is a bit of a wake-up call, and that's been the case for a while, where we're certainly thinking if we've got assets there in that bit of the world, in this scenario, will we get them back? Not just return capital, return of capital, and how that plays out. So there's a whole series of that. And then back to strategic level, I'd layer in that a lot of UK assets have economic participation. Our liabilities, the liabilities of our partners are linked to UK CPI. So it's a combination of that changing geopolitical backdrop. It's ensuring you can play pensions long due. And then the super big picture thing I worry about, like most CIOs do, have lots of worry lists, is what is the shape and form of the economic order 10 years forward? And I mean the monetary system, and I mean the debt system. And it's not obvious to me we aren't going to face significant change in that in the next decade. Don't know. Maybe we don't. Maybe we do.
So, with the geographic distribution of sort of like the world's capital markets being so heavily weighted to the US, and in particular, given the really strong valuations of US tech companies, like if you held a global index, you would have a significant position in US tech just by default. How do you manage that?
Yeah, it's difficult because on the one hand, we can all say, yeah, the US is very dominant in capital markets, MSCI World, what's it, nudge 60, 67% probably, something like that. But where do you go? First of all, if you take a lot of money out of the US, where do you go? Secondly, you've got the argument around, in the long run, it's growth and productivity growth that drives the value of most risk assets. So you've got to bet against the US not doing well at that versus everybody else. And that might be right. Might be right. But you've got to be quite thoughtful about that. I think what I would say is the concentration point in US equity indices, absolutely. It goes back to my comments earlier, actually, on equity and passive versus active. So the example I've been using is most global asset owners have 50% roughly in equities, give or take. Why have you done that? Well, you've done that because everyone else thinks it's a good idea. It may be a great idea, but to explain that to someone, you're like, well, okay. Whereas if you vert that and come from the bottom up, you might say, well, we've got that exposure because we've underwritten it, we've picked to have it, and it aligns with our risk appetite and beliefs. So again, you come back to this point, and then so I think you've got to think about risk concentration, not just in the asset class, total level, thematic risk concentration, aggregate country risk. But it is, as I say, we keep having this debate. It is hard to diversify away a long way from the US, because where do you go? There are other regions you can come up with other good arguments as to why there are other risks sitting there, certainly on the strategic horizon. So it's a really thorny conversation, but it's a case of just being prudent and thinking through where the risks are and being multidimensional about thinking that through.
That makes sense. And obviously, turning those insights and sort of risk management practices into teams and processes. Could you tell me about the kind of hires that you over-index on? So things that you find important that others might not. And how do you combine sort of, a team of great individuals into a coherent team that has a culture and a good set of processes?
I'll try and answer that. I think I've got the question. So in terms of when we over-index in terms of skills and attributes, to me, the heart of hiring people into a team like ours is integrity and basically teamship. So we can train people how certain technical aspects. If someone's got adjacent skills, they can learn stuff. We have some really senior, amazing people in our business who can mentor and teach. But if someone isn't going to act in a high integrity way and isn't aligned with the mission and isn't wanting to be part of a broader team, it's going to be really hard. So, for me, in terms of building teams, it's about that focus is at the heart of its integrity. And then it's like, as I say, part of the team, working with others, bringing people on the journey, and finding people who are really engaged in what we do specifically. And there's a certain type of person that wants to work in the shape and form of our business, whatever label you put on it. But some people would call it global asset owners, some people would call it, I don't know, asset owner, asset manager, pension fund, don't know. And that's what we focus on and try and maintain that culture. But it's not easy to do.
What sort of level of responsibility do you give those individuals versus the decisions that you might make at committee level? And to what extent do they sort of help drive the investment decisions that you're making?
Yeah, it's interesting. And that's evolving through time. But I'm certainly a believer in, sort of call it delegated leadership, and giving people the ability to fail or not fail, give them the mandate, support them, but drive them forward and stretching them. So certainly we still have a heavily governed structure, don't get me wrong, and we have clear accountabilities in place, but it's also finding the right delegations, because the journey we've been on as an investment team, when I first joined 9 years ago, 2017, it was very much centrally controlled by the IC, and we've stepped through increased delegations through time. And at that point, it made sense. There weren't the people to delegate to. Whereas now, if I look down, and part of my framing is to then, how much can I rely on my direct reports, my lieutenants, whatever framing you want to use. So I know that I've got very serious people who I can rely on. and I don't have to check what they're doing. I know they're technically skilled, they're aligned with the mission, they've worked with us as a group for a long time. And we're getting to the point now where their direct reports can also take on serious responsibility and do serious things, and actually potentially even one level down. So that's where you get the maturity of a team, so that you can delegate further and have high confidence. You've got to build around that. But that's the key for me. It's that, giving the ability to grow. And I think the advantage we have is even for some of our junior people, they learn fast because they have direct exposure to see the most senior people and work closely with us.
Totally agree with that.
Part of the sort of individual development is, going through tough situations and coming through and, reflecting on it. Would you be able to share something where it was either a mistake or an unfortunate outcome and what you learned from it?
I've got lots of scar tissue to talk about. I think possibly the one that's most useful and is very relevant, everyone's aware of it, was 2008. So, just replay a little bit of history. I left Old Mutual in the early part of 2008, and I had a bright idea of trading my own money because I thought, this is great, the world's going to hell in a handcart. So I got that call right because I'd been talking about credit traders over the years. And so I had the sort of bearish positioning put on, did really well in the late part of 2008. Did not understand the turn in, was it March, April, when the S&P hit 666. I did not understand that, gave it all back. So I did a really great year trading my own money. I was highly leveraged and it was great, made loads, gave it all back, lost. So over a year I was flat, which actually compared to hedge funds at the time was probably quite good. Many were down about 20% of that period. But still, the things I learned, so many things, like never be short a financial institution during a rights issue because your position explodes. Did not quite cop that. That taught me a lot. But the most important bit, I think, was, and this is something I talk about a lot, when the system is imperiled, politicians are imperiled, and the economy is imperiled, the rules of the game can get rewritten. Let's be honest, the financial system was probably bankrupt in 2008. So what did regulators and governments do? Oh, you know what? We'll change how we value your assets. You're solvent again. So that's what I'm getting at. And that was in COVID. I use the same rationale through COVID. It's not to be silly about it and say the plunge protection team will always be there, but be really mindful when there's a systemic crisis, the odds are skewed that someone comes to the rescue, the money printing starts and similar, or fiscal support, and then think long term about what that means for the value of nominal assets versus real assets. And can those assets survive different future scenarios? So that to me is the big learning. It's that piece around that.
And do you think from that learning, is that sort of had an effect of how your investment style has maybe evolved over the years, and how has that happened?
Yeah, absolutely. So I think, again, quite, I don't know if I've ever said this before in one of these interviews, but if I think when I started, I've come to this, no, because you've asked me a question that I don't think I've been asked before. But I have thought about this for a long time myself, that I started off working with hedge funds and relative value and this kind of like pushback on beta, basically. And to be fair, that's what I started in 2001, 2002, straight after, that was a pretty vicious bear market over that period. So, and hedge funds had a great run in the late 90s, and that's when they were institutionalizing. So I had this mindset of, relative value, hedge out the beta, it's all skill-driven investing. And then, you roll forward to the GFC, and actually most hedge funds had the trade wrong coming out of, they got the sort of bond yield curve piece wrong, let's say, or not that many got it right. And then you had Draghi with whatever it takes. And I evolved into understanding that kind of systemic piece and the importance of, because in some ways keeping it simple, and then into the role of long-term compounding of assets, almost like finding Buffett and Graham again, or Buffett and then later versions of that, and how that comes together. So my style probably has evolved, not to forget the risk management learnings of, call it active trading, hedge funds. So I do think, and as an aside, a throwaway comment, the event I was in a few weeks back was over Chatham House Rules, but it was my deputy that said this. So I don't think he'd mind me saying it, but he pointed out that, and I've thought this, that growing up around, and he also did similar jobs to me when we were younger, around hedge funds through that era was amazing training because there were so many mistakes made by so many.
Yeah.
You had to learn about what was going on. You had to learn how to do investment diligence, operational diligence, and you had to learn how to deal with leverage, illiquidity, concentration risk. And hedge funds in some ways are the ultimate expression of active management because you have the beta bit that's small and the active bit's massively amplified. So you add all that up and then move into the world we're in today, and hopefully that gives you a good grounding.
So before we move on to some of the finishing questions, I'd love to sort of ask, what are the unglamorous but essential parts of the job?
So I think the bit that lots of people grumble about, including myself, even though I've probably written a lot of the rules that people have to follow, is the sort of, call it paper trail. writing papers, the governance, that type of thing. Because for, our process is we have pretty significant, we have a well-governed process. That was where we came from. And I've chosen not to change that. In some ways, we've probably made it more as we've delegated more to me. So one of the parts is making people write detailed investment papers. You could say, we're going to do this anyway. Why do I need to write a 20, 30-page memo? Yeah, it's a discipline of writing it down, first of all, that you've thought about all the points. Then it's communicating with the team. So our process would be, I have delegated authority for asset selection. The team still write detailed papers as if they're going to a full IC. Didn't want to change that. And then they're challenged by their peers. And you go through it in detail, and then it's all filed and logged. And you have that audit trail. So people could say that's unglamorous. It's not the sexy bit. But ultimately, it enforces rigor on the process, people to think about it, enables challenge, and see if there is something doesn't quite work out as you hoped, which happens. You do everything in good faith, you work as hard as you can, but you're dealing with uncertainty. Then you've got something to report to reconcile. What did we think when we did this? And that whole audit trail. So that, I'd say, is an essential part of being an institutional investor, but it's not glamorous.
Richard, just wanted to talk about AI.
Yeah.
So obviously, I hear about and read a lot about AI and the effects that it's having across all types of industries. How do you see AI affecting investment strategies, and how are you working with AI within your organization?
So it's a great point. So I think you'll break it apart. You go through the impact of AI in the portfolio and AI, how you manage the portfolio. So AI in the portfolio is I'm not going to say it's the joker in the pack. I'm in the camp of I was getting muddled, is it fourth or fifth industrial revolution, but an industrial revolution where this is a general purpose transformational technology that will diffuse through the economy and processes and industries and the world, and will have significant impact. And it's certainly not just LLMs, there's way more to it than that. And I don't know who the winners will be, and quite possibly the winners might not even exist yet, or that kind of narrative. So how you implement that in a portfolio today is quite challenging. And impact of edge computing, will all these data centers, will all the capex be the wrong price? Let's say, who knows? So there's all of that bit, but back onto within the investment process, we're certainly evolving and experimenting and finding a way, thinking about it, call it test cases. We're certainly thinking about how they could work. We're not using huge amounts of, certainly, operational due diligence. Certainly we're doing more and more of that because it's a case of lots of data in documents. How do I extract it? How do I line it up with our key criteria? That can really speed us up, for example.
What advice? So let's say someone were in the very early stages or considering a career in finance. What advice would you give them? And could you also give us a sense of what does it mean to be having the wind at your back?
Yeah, so I end up having these conversations with people, either our juniors or interns or whatever. And I talk a lot about having the wind at your back and thinking strategically about the long horizon. Don't get too caught up in the short-term noise. And what I mean by that, and I mean this both in terms of the portfolio and in terms of your career. So in terms of the portfolio, a wise, successful hedge fund manager said to me a year or two back, well, get the 10-year view right, and then you can make some, always have to get the stock selection right, which I thought was quite correct. The 3 or 4 big drivers: inflation, deflation, rates, globalization, whatever. And I think that's right. And that's certainly how we think about the portfolio. On the personal side, I think I'd like to say I've had divine insight and I'm really clever. I think it's more just a bit of luck. For various reasons, I've managed to be in sort of the right place at the right times as structural growth drivers in my career. So I started working in hedge funds in 2002 as that industry kind of blossomed, let's say, grew massively through institution and in that multi-manager bit. By 2008, 2009, a certain individual called Madoff threw up a few challenges to hedge funds, and I did my own little thing for it. But it was then a pivot into the disintermediators, basically the consultants, the Allborn and similar. So that was then the next growth phase of the skills I had. And then in 2017, I had the luck, maybe it was foresight, of working out that the wind was then going towards the global asset owners and these teams were growing. So that's what I'm getting at is if you're in a structurally growing area, you don't have to always be top decile. You can do really well. But compare that to people who maybe trained as journalists of my era, where it was really, really hard to make a living because it was continually declining. The newspapers were declining because of the changing world order. So that's what I'm getting at. That's the wind at your back. So it's trying to do that from both those portfolio and career perspectives.
So, final question for you. What would you want your legacy as a CIO to look like, or even to be?
So the most important thing is all pensions get paid in time, on time, in full, affordably and efficiently. That's the mission, and that's serving our partner funds to do that. If I focus internally, I would like, first of all, for the team to have grown a whole series of internal leaders in the team. So if anything happens to me or whatever, the team can just keep functioning. That to me is leadership. that we've grown leaders who understand their job, they understand the mission, they know what to do. So it just rolls on, and maybe one of them moves in, but you create that culture of you grow more leaders, then it's delivering, as I say, on the portfolios of the team, the culture's intact, and LTPI continues to grow and prosper and execute on the mission to serve our partner fund. That, to me, would be the ultimate legacy.
That's fantastic. Richard, it's been an absolute pleasure. We're not finished just yet because we have our favourite space now. So be ready. Quick fire round. Hopefully you're not prepared, although if you've listened to some of our other podcasts, you probably are. Favourite sport?
Rugby.
Six Nations coming up shortly, isn't
Yeah, absolutely. I'm a Welshman now, so it's not much fun at the moment.
it? Favourite film or TV drama?
I also just say The Shawshank Redemption.
Oh, great film. Someone else said
Great
that,
film.
I think, in the previous.
Yeah, there probably are some more recent ones. And if I was going to be slightly cheesy, you probably go with Top Gun and Top Gun Maverick as well. They're, if you're going to watch something with the kids, they're sort of, my kids are just about old enough to watch those now. You can buy into it, and they say it's a whole different era.
I have to say, I was very surprised how good Top Gun Maverick was.
Yeah, exactly.
As in, compared, on the basis it was, what was it? I don't know, 20 years after, 30 years? I can't remember now. Anyway, favourite drink?
On red wine.
Good call. What from where? France, Australia, South Africa, Argentina?
Yeah, it's probably Italy. I love all things
great.
Italian. I love things Italian.
Barolo.
Yeah. And yeah, absolutely. But anything Italian, culture, food, wine, can't go wrong.
I've been drinking a very nice Sicilian Appassimento, so you must give that a go.
I will do.
Favourite book?
Oh, it's maybe a bit, it goes back to the original one. One of the books I think is one of the best things I've read in a long time is Legacy, the All Blacks book about leadership management and what the All Blacks can teach you. That is a cracker for just putting things, the captain sweeps the shed. Remember that one.
Yeah. Very good. And lastly, favourite hobby?
Driving my kids everywhere. That's what I spend my most time doing.
Is that a hobby?
Well, I'm not sure it's a hobby. Well, when your kids are of a certain age, hobbies just sort of go out. It's like you got to try and find some time to go and see people. I'd love to spend more time getting some exercise and similar to that, but it's a bit squeezed at the moment.
Listen, Richard, it has been an absolute pleasure. Thank you so much for joining us.
Thanks, Richard.
Yeah, thanks for having me.
Yeah, and we look forward to seeing you another time soon.
Perfect. Thanks so much. Thank you.